Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we begin in Asia. Japan has unveiled its own version of the Department of Government Efficiency, a nod to the cost-cutting agency once championed by US President Donald Trump, in a move aimed at reassuring jittery financial markets about Prime Minister Sanai Takaichi's ambitious spending plans. A new Office for Review of Special Tax Measures and Subsidies, informally branded DOGE Japan Edition, was a key demand of the reformist Japan Innovation Party during coalition talks that helped secure Takaichi's historical election as the country's first female prime minister. The launch comes just days after Takaichi announced a 21.3 trillion yen, $135.4 billion stimulus package, the largest since COVID-19 restrictions were lifted, with measures ranging from energy subsidies to cash handouts and rice coupons. Markets reacted warily, bond yields climbed, the yen weakened sharply, and traders began factoring in the likelihood of government intervention to steady the currency. Against this backdrop, officials hope DOGE will demonstrate at least a symbolic commitment to fiscal discipline. Quote, financial markets have become concerned about Takaichi's fiscal expansion and long-term risks to the yen, end quote, said Takehide Kyuchi, executive economist at Nomura Research Institute, adding, quote, DOGE is maybe a way of reducing this kind of stigma, end quote. Yet Kyuchi cautioned that the Prime Minister remains fundamentally expansionary, raising questions about how far the efficiency drive will truly go. Unlike its more theatrical US counterpart, once fronted by Elon Musk, Japan's DOGE will be a much more restrained affair, overseen directly by Takaichi and managed by Finance Minister Katayama. At its inaugural meeting, Katayama emphasized public engagement rather than headline-grabbing targets. The government plans to solicit suggestions via a new consultation mechanism, potentially including social media platforms such as X, asking citizens which subsidies, tax breaks, and state funds they view as wasteful. Early crowdsourced proposals have ranged from defunding the national broadcaster, NHK, to cutting grants for private space ventures, though such areas lie outside the scope of DOGE. For now, the office will focus on the roughly 1.7 trillion yen in corporate tax credits and other special measures claimed by nearly 1.5 million firms last fiscal year. Economists agree that some trimming is overdue. Pandemic-era spending has never returned to pre-crisis levels. Still, analysts warn that previous Japanese attempts to streamline government have yielded only modest results. Whether DOGE marks a real shift or merely a cosmetic one remains to be seen. Quote, in the long term, the government should be more efficient, end quote, Nomura's Kyuchi said, adding, quote, I hope Japan's DOGE can cut wasteful spending, but no one knows how long it will survive. End quote. Meanwhile, while we're on Japan, Japanese government bonds have tumbled after the Bank of Japan Governor Katsuo Ueda hinted a December rate hike is under serious consideration, sending the 2-year yield to 1.02%, its highest since 2008, the global financial crisis. Yields across the curve jumped while the yen strengthened. Traders now price in more than an 80% chance of a hike on the 19th of December, up from 23% a week earlier, after Ueda said conditions would remain accommodative even with higher rates. Additional pressure came from plans to boost short-term debt issuance to fund Prime Minister Takaichi's stimulus package, weighing on shorter maturity bonds. And all this market talk brings us nicely to our next development as we now move to North America. The traditional year-end tailwinds on Wall Street were nowhere to be seen Monday as US stocks slipped at the start of what is historically a strong month. A sharp sell-off in cryptocurrencies and a surge in Japanese bond yields weighed on sentiment, prompting traders to rotate out of riskier assets. The S&P 500 briefly slipped below 6,800 before clawing back to a marginal gain. The pullback followed a choppy November that still delivered the index's longest monthly winning streak since 2021. The real story, however, was with cryptocurrencies. Crypto markets, which have been called a mega bubble, deepened their rout, with the trillions-dollar Bitcoin tumbling as much as 8% to around 84,000, and Ether down nearly 10%. Roughly $1 billion of leveraged crypto bets were liquidated amid the plunge, a continuation of a broader sell-off that began in October, when $19 billion in positions were wiped out. Smaller tokens fared even worse, with a market vector index of lower-tier digital assets now down nearly 70% this year. Quote, risk aversion is creeping into the markets to start the week, end quote, said Carl Rodder of Capital.com. While investors continue to price in a Federal Reserve rate cut at next week's meeting, this week's data from factory activity to Friday's key inflation print is unlikely to shift expectations materially. Seasonality still offers hope for bulls. December has delivered the S&P's second-best average return since 1990 and historically shines brightest when the index is already up double digits entering the month. Analysts at LPL, Financial and Nationwide say that the backdrop remains conducive for a so-called Santa Claus rally, typically concentrated in December's second half. Yet for now, digital asset volatility is clouding the broader picture. Bitcoin ETFs saw only modest inflows last week after heavy outflows in November, and concerns mounted after crypto-focused Strategy Inc. disclosed a $1.4 billion reserve to shore up its balance sheet. Still, some traders see stabilization ahead as we move into the final weeks of the year. Now, we will continue to follow all things market and economics related as we move into the weeks leading up to Christmas too. If you want to be on top of these updates, consider subscribing to Market Update. Hit the bell notification icon and you'll have them as they are released. And if you're getting some value from today's episode, as always, it's a huge help if you can just hit that like button. Thank you so much. And finally for today, we move to Europe. Rising public deficits and mounting debt burdens across the Eurozone are triggering fresh warnings from the European Commission, which says a growing number of member states now face, quote, sustainability risks, end quote, under the bloc's fiscal framework. For regular viewers of Market Update, this will be coming as no surprise. The assessment released this week underscores how surging demand on public finances, from sluggish growth to geopolitical shocks, are complicating governments' efforts to meet EU spending rules. EU fiscal rules require member states to cap budget deficits at 3% of GDP and to maintain debt levels below 60% of GDP. Yet the Commission's latest review shows that after several years of improvement, both deficits and debt ratios are once again drifting higher. Quote, we need to remain vigilant, end quote, EU Economy Commissioner Dombrovskis told the Financial Times, warning that aggregate Eurozone figures are now moving in the wrong direction. The Commission identified the Netherlands and Malta as the two countries whose 2026 budget plans clearly breach spending limits previously agreed with Brussels. Their projected expenditures significantly exceed the caps set under the reformed Stability and Growth Pact. Spain, Croatia, Lithuania, Slovenia, Bulgaria, and Hungary also show non-compliance, though to a lesser extent. Adding to the pressure, the Commission has recommended placing Finland under an excessive deficit procedure, EDP, after the country's deficit rose to 4.5% of GDP last year. If approved by EU governments, Helsinki would become the 10th EU member subject to the corrective mechanism, which, particularly for Eurozone countries, can ultimately result in fines if spending is not brought under control. However, Dombrovskis acknowledged that Finland faces, quote, exceptional circumstances, end quote, including the economic fallout from the closure of its border with Russia and ongoing security concerns that have pushed defense spending higher. Any required adjustment, he said, would take these factors into account. France, as usual, presents another complex case. Although Paris entered the EDP last year and recently failed to pass a budget that would curb spending, its latest draft plan remains, quote, compliant with the requirement of the fiscal rules, end quote, according to the Commission. Nonetheless, Dombrovskis cautioned that the final budget emerging from France's turbulent political process will need to align closely with its commitments, including a targeted deficit of 4.7% of GDP by 2026. Italy, by contrast, appears poised for an exit from its deficit procedure. The government, led by Prime Minister Meloni, has projected a decline in its deficit to 3% this year and 2.8% by 2026, putting Rome back within the EU's fiscal boundaries. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I hope to see you for the next episode, which will either be tomorrow or on Thursday.